Good afternoon, good morning, and welcome everyone to JustWorks' Ask an Expert series. My name is Moses Ballion. I'm an HR consulting manager at JustWorks, and I'm excited to talk about today's topic, which is scaling your business after raising the capital. Thanks for joining us. A few housekeeping details before we get started. Your audio is muted by default so that we avoid any feedback. We also received some questions upon registration, which we will address at the end of the webinar, and we'll have time for some live Q&A at the end with our special guest in keeping with the Ask an Expert series. Lastly, this webinar is being recorded, so for any registrants or attendees who would like to view the session later on, they can do that via the email that they will receive later on. Our standard disclaimer that this material has been provided and compiled for informational purposes only, so please do not take it as legal or tax advice. We trust you won't. That said, lots of phenomenal insights today from our guest, Berk, CFO of Early Growth Financial, who has so generously volunteered to share his time with us today. So Eric, such a pleasure to introduce you. Thank you for joining us.
Hey, look, it's my pleasure to be here. You know, really excited to share with you guys and both learn about your businesses and also just talk about kind of where we are currently in kind of the cycle and climate. So looking forward to chatting.
Fantastic. And could you just give us a minute or elevator pitch about your role, your background, the types of companies you worked with in their stage of growth?
Sure. I've been lucky enough to be the chief bottle washer, CFO, VP of finance, whatever you want to call it, for a bunch of high growth tech companies. I've been lucky enough to, I'll give you two companies. Security Scorecard, we were doubling revenue year after year. And, you know, that hyper growth business is an awful lot of fun, but also a huge challenge. And we'll talk later about kind of what that challenge means to us. The other company, I was employee number 35. We grew from $9 million in revenue to 23 million to north of 50. I was there from the Series A round. I walked in as CFO with a junior accountant and a bookkeeper. 2 years later, we ended up selling to a strategic for almost $400 million. It was a great run, but it got really weird for me when I suddenly didn't realize names of people that we were hiring that I didn't know. There was a time I knew everybody. You know, at 250 people, it just didn't work that way. So I've been lucky enough to do that. And right now I for about 12 companies, help manage their growth and work as a consulting CFO to the founders and the team. So I just love to kind of share in that growth. And that's really what I'm here to do today. So I hope that makes sense.
That makes perfect sense to me. How exciting. As a sort of outsourced HR professional, I get it. And it's exciting to be able to help all these different companies at various stages of growth, and really appreciate, and that resonates with me, that once you get past the sort of tribe where you know everyone's names and have to, it becomes a true institution.
Yeah.
Well, great. If I can run through your agenda today briefly, what we'll cover. First is firming up your plan. Seconds are metrics for transparency and success. Excited to get into those actionable insights. And then building your internal organization before, once again, we'll open it up to about 10, 12 minutes of Q&A directly with Eric from our live participants. So let's dive into firming up your plan. I want to start by, thinking about what kind of company you're trying to build and really getting back to basics. So what can you share with that about that?
Yeah, I mean, look, for all of us, we probably had a 10 to 13, slide pitch, which we kind of carried with us, became our Bible, went through it many, many times. But one of those pages, and it was probably the last page, and if you look at Guy Kawasaki, his kind of 10-page standard deck, page number 10, a little of it has something called, use of funds. And look, it's a great position to be in, because at this point we've talked to our investors and indeed we have funds, but now comes the real challenge, right? What do we, and real challenge is funny because at every step of the way, everything feels like a real challenge, but here it really is, how do we take kind of this idea that we have of how we want to grow the company and turn it into something more granular? And what I really mean by that is try and, as best you can, break down the investment into pieces. First off, it's the only way I know how to manage it. Small bite-sized pieces. It allows the team to really stay focused. It allows you to stay focused. And again, the granularity is really the hard part. One of the challenges for founders is just that issue of focus. And especially now, if we suddenly have X number of dollars in, there are a bunch of things we want to do. It's all this pent up demand. But I'm saying create a process. And that process really is some of the things we've laid out here. Break that investment into pieces, break it again into ideally have timing and milestones. Don't wait for the end of the investment to assume it's successful. Each month, what are we trying to achieve? Every 2 weeks, it really depends, but it really is the issue of managing these funds as well as we can, because it's hard to getting capital once is awesome. Getting it twice is even more difficult to some degree. So let's make sure we prove that we're good stewards of what we've been given. So I hope that makes sense.
It makes total sense. And I've heard from a lot of different sources the importance of being more agile and pivoting and reassessing ever more frequently. Whereas before, quarterly budgets were acceptable. Now, 2-week cadence, as you said, is much more the conventional wisdom these days.
And I'm sorry. No,
Please.
Go ahead.
I was just going to say elephant in the room. Let's talk about how COVID has wreaked havoc on everything. Just love to hear those insights when you get to it.
Yeah, I mean, it is again that issue of as we've already talked about, the ability to pivot and to build value. It really is important of having that plan that we're able to compare to. I know it's a pain in the neck to create a budget or some kind of financial plan, but it's critical. Because it allows us to just make sure we're moving in the way we want to. One of the things kind of post-COVID, and it's a simple way to kind of take a look at your company. I call it the BMI for kind of evaluating companies, is a rule of 40. And basically it's a simple way for us to kind of take a look and say, okay, are we kind of in good shape, not as good shape as we want to be? We're really hitting the calories now. And it's nothing more than revenue growth year over year plus EBITDA margin. So effectively, if you're growing at a 50% year over year revenue growth, rule of 40 says, your EBITDA loss should be 10% or less. That kind of puts you as a healthy company from the issue of how much am I burning versus what am I gaining up top. Conversely, if you're growing at say 100%, okay, so we're doubling revenue year over year. Kind of the rule of 40 says then, a 50 or 60% burn isn't bad today, with the assumption of what the future value is of the revenue you're bringing in today. So for a SaaS company with normal good dynamics, low churn, that's just a way of looking at yourself. And it's just a simple thing that we can always be looking at and saying, where do we want to get to on this number? The other thing is there's a lot of money out there. I look at my little portfolio of 12 companies that I'm helping with. 3 of those companies have actually gone out and raised funds during COVID and closed. It's there again, and we'll talk about it. Part of, I think, what they did to help in that was break use of funds into a more detailed component so that people were able to really understand, look, we're raising 7.5. I want 2.5 to sit here. Of these 5, here's how I'm going to use it. This is the timing of what I'm going to do. Here's the ROI on my investments. It's those kinds of pieces that helped make that happen. But the good news is it's not as if, money is with a mask. It's out there.
Mm.
So,
well, I'm excited to dig more into the emphasizing profitability as far as securing funding. It can't just live on a prayer and a dream anymore. Really have to show some more detailed plans, and that's where you, Mr. CFO, come in. So let's talk about profitability and spending more wisely. I know it's a lot more than just penny pinching, so I'd love to hear some insights on that.
Yeah, I mean, look, nobody has ever saved their way to prosperity. So while it's important to manage how you spend, look, what we're all looking to do is grow the top line, right? Because we believe we've got something great that we've developed. We think there's a real opportunity to monetize it. So growth has to come on the top line. But now has been, and I found during COVID for some of my companies where there was some slowing on the top line, it's been a great opportunity to look at operations and internal strategies and process and marketing and really try and get that as finely tuned and honed as you can, so that when you do move forward and invest some more, you're going to have the infrastructure to be able to do it. It's all about scale. Okay. And the issue is build for scale now. And I look at that, it's as true in marketing as it is in finance. So I've got little companies that I'm helping that have, 4 people. We still have put in, a general ledger system. We still have Expensify to handle T&E and Bill.com for payables, so that we've got the right systems to be ready when we really turn on that spigot and growth happens, because it gets really crazy. So we've got to today be prepared for it. The other thing is not everything is going to work. Okay. And one of the things that kind of talked about earlier was the idea of having yardsticks or KPIs or metrics. Where should we be at the end of month 1? Where should we be at the end of month 2? Some things we're going to have to walk away from, or we're going to need to fine tune and change. But that's where it's really important for us, I think, to again have the project planning to allow us to be able to measure it reasonably. And then, I always think we need to keep some of this in our back pocket, because, stuff happens. So, if you get X, let's make sure we put 25% of X in our back pocket, or let's build the use of funds that way, so that we're being, again, good stewards. And I come back to that, but it's remember, we've got to treat it like it's our nickels, our pennies, our dimes, our dollars. But again, not spending isn't the right thing. It's a matter of spending wisely. And again, I think that comes down to really understanding what you're spending on, which again, to me, goes back to this idea of the detailed project planning. So I'm sorry I keep coming back to this same thing, but I think it's kind of the right base to build on. And what we'll talk about soon are kind of, how do you measure it? Because I've talked a lot about this measuring, but it's not necessarily an easy thing to do. So there, I really like metrics. Okay, and they're metrics that we share in the organization to become part of our DNA. It's just a way for us to compare ourselves to everybody else in the universe we're playing in. And one of the hard things I know, because I've lived it, is you really believe your company is the best thing since Swiss cheese and sliced bread. But metrics allow us to say, hold on, we may not be as good in this area as we thought we were. So many of the investments that we're going to do when we look at use of funds are going to be to either try and grow our top line, which means investing in sales, investing in marketing. Okay. It's many times it may be a land grab that we want to do because we're early into an area. So we've gone out and asked for funds so that we can try and go and grab market share. But we need to do that in a way that I think is long-term sustainable. And here are a handful, and there are a million metrics out there. And the first thing I want to say, guys, is simplifying the metrics. Only use 3 or 4 just have a handful that really are best suited for managing or looking at your business. Having a million of them doesn't help, because you just can't stay focused. But let's just look at these 5, which are very simple. I'll run through them. CAC per dollar of new AR, just customer acquisition costs. How much are we paying to get a customer versus each dollar of new ARR, right? We need to have that be, if we're at 0.5, it means that effectively it's going to take us 2 years, or more than 2 years really, to pay back this investment. If it's 1.5, it means let's go to town, because we're, moving in a certain direction. The magic number. The magic number is nothing more than looking at growth in ARR on an annualized basis divided by your acquisition cost. So it really is kind of the inverse, but it's another good way of measuring. You want that to be 0.75 or more. If you're below 0.5, you probably really want to look at your sales organization and marketing organization and say, let's test more before we go and spend more. But that's just another good way to compare yourself. Time to close to me is really interesting, because it really is, and it is hard to truly get your hands around it, because it's from the moment we talk to the customer to when that customer actually closed with us. The problem with this is there are many people who touch the customer along the way. So it's not a precise number per se, but it's a good indicator. Are sales taking 6 months or 3 months? If they were 6 months, how do we move it to 5 months? What can we do to tighten that?
There's probably no really right number for that, right? It all depends on the complexity of your product.
It totally depends on complexity of product, market. Big enterprise sales can take a year to 18 months.
Sure.
And that's just the sales cycle. Churn is another one that my sales guys hate when I put in here because, sales feels they're hunters. However, they brought the customer to us. They have the relationship initially. I really want that salesperson to be part of a monthly or quarterly review with the customer.
Totally.
So, and then last is the sales equation, which kind of pulls all of this together. So the sales equation is nothing more than average order value times number of leads times whatever your percentage of closes divided by number of days to close. So it's kind of taking all of these pieces and plugging them into one. But guys, it's just a way of saying, look, we expect that our CAC early on, will be negative because it's going to take us some time to build up this marketing plan. But where do we expect it to be at the 6-month period? What should that pipeline be looking like? Maybe instead of this, it should be pipeline or it should be conversion. But you'll figure out together with the people in your organization what the right metrics are. But I think they're really important because they allow us to just share on an even keel. And then the last thing you want to do, especially for sales, is really test the bonus plans. I've been burned in the past where we built something, thought it would create behavior A, ended up creating behavior B. And that's just really important because especially if we're a young company, this may be the first time we're beginning to turn to some outside sales, outside of the founders or outside of a very small group. So it's just really important we split test those.
I'll just to throw out some actionable specifics. As an HR professional, I've always really admired the withholding some commission payments until a certain retention threshold has been met for new customers. Just throwing some creative ideas out there for our compensation analysts.
Yeah, I mean, look, many times you may want to have some annual component of the plan, right? Just because, again, depending on the seasonality of the sales and timing of the sales. Look, the other two areas we tend to invest in would be customer service and tech. And again, there, I think it's important for us to have some ability to look. NPS, Net Promoter Score, is a pretty standard. It's imperfect, again, as they all are. A couple negatives can really move that in a funny direction, but it's important to see, and it's important, I think, for you to look at over time. On the product side, my hope is, as we're building product, we've got some ROI associated with that product build. So what are the enhancements? What does that mean for us from a marketing and sales point of view? Were these enhancements driven by, coming from the sales organization? They come from the tech organization. They come from customer service. Obviously, churn, again, whether it's customer service or, quite honestly, product, because good sticky product doesn't churn, right? And especially if we're truly integrated into our customers' workflow. So if we're able to make that transition and kind of be part of process, we're in a great place. And then I'll put time to close out here because these are all folks who are involved in the close process. When I think of tech, you may have some service engineers who were involved in the close process. There may have been a demo that was done. So again, it's just trying to keep the organization focused on some key external numbers for us to manage to.
I think this pairing customer success and tech or product they make for strange bedfellows intuitively, but they are two sides of the coin when it comes to NPS, customer satisfaction. And I would just encourage our viewers to ponder where ownership lies over those metrics, and to really take a look at whether the product or customer success can be attributed to your successes or shortcomings as far as customer satisfaction goes. It's a tricky equation, probably with variables that are impossible to balance, but worth considering.
Well said.
Thanks.
And look, to do it all, we need to build a strong internal organization, right? I mean, we've gotten to a certain point with what we have and the heft and all the energy we've put into the organization. But this new investment allows us to move to a newer level. And now, the issue is, how do we hire the right people? because it ain't easy. And to me, the most important thing that keeps high growth companies working well is culture. So, and that culture really starts at the top, but it really is, what's the DNA of our company? And many times the metrics should reflect some of that DNA. So if, for example, Automotive Mastermind, one of the companies I talked about earlier, we were really, really focused on customer service. That was, we sent people out when we installed our software. We made sure that they visited the customer at least once a month. So, churn was a huge internal metric for us to look at. NPS was a huge internal metric for us to look at. But you want people who, I kind of call it the airline seat, although it's probably not really practical in the current world. But, would you want to hang out with that person? Because you're going to spend a lot of time. So I think that culture is really an important piece. Mose, I know you've seen a lot more on this than I have. I'd be curious your POV.
Certainly. Well, I think you've got to take a look, or I would encourage companies of a Series A size to, how proactive do you want to be about like imposing sort of cultural norms and values upon your people versus really taking a look at who you've already hired. You probably got to 5, 6, 7, 10 employees without thinking too explicitly about the culture questions. Take a look at what made you want to hire those people, whether it's a combination of skills, acumen, or just a propensity, an ability to learn, and use that, boil it down, and find out what makes your organization tick, and then maybe take a look at what you're missing. And then you can really put those values down on paper and encourage them and propagate them through a shared language, shared behaviors, and find a way to keep this thing alive, because you can't just put posters on the walls and say, this is our culture, right? Your systems, your language, and your leaders have to reinforce the way you provide positive affirmation, the way you provide constructive feedback, and then even what you call certain things, what you call your social events. These language really matters a lot.
Very true.
Thanks. Well, you're used to life at the top, Eric, in your leadership position. So what can you say from that perch as far as maintaining culture and your role in it?
Look, culture starts at the top. I mean, if I'm not living the same values I'm talking about, it becomes a really clear separation, and that really is damaging. Again, for me, it's been, as a finance guy, getting those metrics that we talk about. So we would literally start every town hall, every touch meeting with the 4 metrics we were focused in Mastermind. We built them into bonus plans. But again, the real and culture. The other thing you find is that culture really helps, again, keep us linked and working and being aligned. And especially in hypergrowth, where people come in and it's crazy by definition because you're growing so quickly. I just think it's really, really important. So I hope that helps, Moses.
It definitely does. And now this is really the confluence of our two worlds, using metrics in your bonus and incentive plans. We talked about looking at comp structure before, but how can we infuse our compensation, our culture, into our compensation directly?
Well, I think you do some of that by just the attaboys and attagirls, how you day to day celebrate what you do. Because, a once a quarter rah-rah is very different than every other day seeing stuff about what's being built, who's doing what. So
Shout-outs, yeah.
I just think that becomes really, really important. I think it's those, we over communicated at some of my companies. We literally, after a board presentation, would take a redacted board presentation and share it with the whole company.
I love that.
Because we're all in it together, guys. Whether we have 10 employees or 100 employees, we're still at a point where, we're not public. We have funding issues, whether we're profitable or not, because things happen. But, let everybody be part of the process. So that's
awesome.
That for me was kind of the key. The key. It's transparency and consistency.
And my mantra in light of the pandemic has been, be deliberate. There's lots of areas where we used to be able to let things run on autopilot or it's working. But when it comes to communication, when it comes to celebration and the way the business rewards employees, be deliberate about this stuff and really think about it. It might feel awkward. It's things we're not used to, like being mechanistic or methodical about, but introduce methodology into areas where you haven't before. It'll pay off. Well, great. In summary, Eric, why don't you take it away?
Sure. I mean, look, it's an awesome position to have just received capital, right? I mean, it's one of the headiest. God, I mean, I think of the times when my head has exploded. It's when we received capital. It's when we actually sold Mastermind to IHS Market. But the next day, suddenly, now it's happened. What do we do? And again, own the process. And that again gets back to being as painfully organized as you can be. Break this project down into a series of steps, have the right metrics, have the, again, be as transparent as you can about, sharing the data. But I just think it's recognizing that we're now in a position where we can run, but we really need to understand where we're running to and how we're going to run the race. So let's understand what that strategy is. Let's pace ourselves where we need to, and let's, go as hard as we can where we need to, but again, have that plan, and communicate that internally in the organization, communicate that with your investors. Because I think investors feel really good when they're able to talk about what you said you were going to do, where you are, and now where you're going.
Totally.
And that consistency and that dashboard effectively becomes just a great tool for the entity. So hope that makes sense, guys.
Makes sense to me, and I'm sure our viewers have all found this incredibly insightful. And now, the moment we've all been waiting for, we get to ask the expert. So let's jump into some Q&A. And we did have some pre-submitted questions from registrants. So Eric, can pose this one to you right off the bat. What types of programs can a company create internally to support, attract, and retain talent?
I think there are a couple things, right? I mean, one is getting back to, as we talked about, the shout outs and the, just the recognizing what people do, and making that really important. I think another thing is just making sure we're training people, and the programs there are, it's helping managers become better managers. It's really supporting, and in a small company, you may not be able to do that when you only have 10 people, but when you get to the 50 people mark, there are things you can now do, that really help. I think the most important thing, and this is going to sound bass backwards, about, attracting, retaining talent is hiring right in the first place.
Yep.
Okay. And maybe I'm just, because I'm a finance guy, I'm sloughing it off, but I think that's the key. I'd love to see your point of view, Moses.
Yeah. I mean, I couldn't have said it better myself. Be deliberate about hiring, hire the right people, understand what you're hiring for, and don't mistake charisma for competence. That's one of my adages. Have some sort of evaluation process, or really dig into people's skills and penchant for learning before you get as excited about them as they are about you. Also, my one tidbit that I always share when it comes to retention is have a smooth onboarding process. And you touched on orientation, but I mean onboarding too. And that goes from filling out the W-4s and I-9s to training, to welcoming individuals to the company. Onboarding, that first impression, has a disproportionate impact on an employee's engagement and how long they stay at the company. Studies have shown this. I don't have numbers off the top of my head, but pay attention to that. Have elegant systems. Make sure that employees are welcomed, their equipment is ready when they show up at home in front of their laptop, or once we return to the office. But can't stress that more. Can't stress that enough.
That makes total sense.
All right, great. So that was our pre-submitted questions. I'm excited to jump into some live Q&A. All right, Eric, here's one. What do you have a favorite culture component, like whether it's communication, work ethic, penchant for learning? Like I said, do you have one that's just a favorite of yours or really resonates?
Yeah, I guess mine is kind of the communication component of it.
Mm.
When we're able to share and work together, great things happen. And I think that's kind of leaving the ego at the door, taking off the title, and just recognizing that, today is going to be totally different than yesterday, but I'm going to have fun doing it. So I hope that answers the question.
It does answer the question. And I encourage people to pay attention to your systems. When do you favor chat versus email? And again, coach your employees and be deliberate about which communication methods and systems to use for various means, whether it's celebrations, shout outs, or just, employees chatting away and developing a friendship at work. How do those conversations happen? Well, with that, I just realized we're at time. Eric, I just want to thank you again so much for the generosity of your time and for joining us today.
My pleasure. Glad to be of help.
Great. Be safe and be well, everyone.
Yep. Thanks, guys. Have a great day.